We have aging demographics, so a lot of people have invested for some period and are soon going to be looking to essentially live off the proceeds of those investments.
Hello, you're watching Proactive. I'm joined by YieldMax ETFs Chief Strategist, Mike Khouw. Mike, very good to meet you. For European investors new to YieldMax, what are these ETFs designed to achieve and how does the covered call strategy work?
So our funds are designed to give, some upside equity participation for the underlying securities represented by each of the funds, rather than a strict covered call strategy. So we'll just quickly talk about what that is and how ours differ. In a covered call strategy, you own the underlying security and then you sell an upside call against that. The objective in that strategy is to collect a little bit of premium from somebody who might desire to purchase the security from you at a higher price. The downside of that strategy is that, of course, you're capping your upside gains to the difference between the current security price, the strike of the call that you sold, and the premium that you collected when you sold it. In our case, we actually just sell upside covered call spread. So we do sell that upside call. We buy a higher strike upside call as well. The purpose in doing that is that stocks often trade within a range, but periodically you'll have these idiosyncratic events where a stock can move, an abnormally large amount. We don't want to sacrifice the gains in those events. And so by selling a covered call spread, we're still collecting a bit of options premium, but we get participation if you get one of those outsized moves. We target collecting about 80% of the upside in those situations.
You've launched a number of ETFs with HanETF, so YMAG, MSTY, LT, NATY, and CHPY. What's the investment strategy behind them and how do they differ?
I mean, the principal distinction between some of the funds that we have, so something like YMAG is basically a portfolio. Think of it as kind of a fund of funds, if you will. So a number of the YieldMax strategies are embodied in that fund. Then we have sort of thematic or sector-based exposure as well. So something like NATY, which is exposed to the defense industry, is going to have just exposure to those underlying stocks. CHPY is, as the name would suggest, exposed principally to semiconductors and chips. So it's sort of the IT hardware space, which, as you might expect, has been a pretty good space to be in. And then we also, in the case of MSTY, are offering strategies that are just one underlying security. In that case, it's Strategy, formerly known as MicroStrategy, which is the Michael Saylor run company that is basically a Bitcoin play. So, there's basically the more diversified, the more thematic and sector-based, and then, of course, the single stock strategies as well.
These products target high monthly income, but as you explained, investors give up some of the upside. Who are they best suited to?
I mean, I think these are best suited for people who are looking to find that balance. Once upon a time, people would invest in stocks because they paid dividends. So they were looking for some exposure to the growth of an underpinning business or group of businesses, and then also collecting some income in the form of dividends. Now, more recently, it's less common for stocks to pay big dividends. So this is looking to create a bit of a substitute for that so people can still collect some income from their investments. So it's kind of a balanced approach where you get some equity exposure and then you're also going to be collecting some income from those underlying stocks.
So how should investors think about these ETFs alongside traditional equity and bond holdings in a balanced portfolio?
Well, I think the word is balanced, right? Because what they are is some measure of equity exposure and a little bit less of it, right? Because you're sacrificing some of the upside by selling those upside call spreads. That also has the effect of reducing some of the downside volatility as well. So on a risk-adjusted basis, the returns should be about as good as they are with equity, but you're giving up some of the upside participation in exchange for some income right now. So I would think of these as sort of equity light, I guess, might be one way to think of it. It's not quite like a bond. It's going to have more equity exposure than a bond would, but it's going to have somewhat less, and you're going to get a little bit more income. So, if you're thinking about everything on a sliding scale, cash and interest on cash being the most conservative, sort of income-focused approach, and straight equity exposure in stocks that pay no dividends being the most sort of risk-on equity exposure approach, this would be a little bit less towards that end of the scale.
I mean, with exposure ranging from big tech and crypto-linked equities to defense, what role do you expect these products to play as European investors increasingly look for income?
I think for European investors, very much like the ones in the United States and elsewhere, We are seeing increased interest in options-based strategies. We're seeing increased interest in income-based strategies. I think in a lot of cases we have aging demographics, so a lot of people have invested for some period and are soon going to be looking to essentially live off the proceeds of those investments. And I think also there's been a lot of innovation and flexibility offered just within the types of products that are offered. And so it only represents about 1% of the entire ETF space in the United States and probably an even smaller one in other parts of the world. But I expect that to increase materially as people begin to look at this as an alternative to conventional fixed income investments.
Mike, thank you very much for the introduction to YieldMax today.
Thank you very much.
That's Mike Khouw. He is YieldMax ETF's chief strategist.